Hi everyone, welcome back to Corporate Decoder, the place where we, decode corporations. Today we're diving into a report from the Federal Home Loan Bank of Dallas. Don't let the name fool you, this isn't your average neighborhood bank. We're going to look at how they're managing their money and what it means for the bigger financial picture. Think of it as trying to understand a complicated recipe. But instead of cookies, we're baking up debt. This report is a Form 8K, which is basically a quick update a company sends to the Securities and Exchange Commission, or SEC, about important events. This one is dated April 7, 2025. It's all about debt, specifically something called consolidated obligation bonds. So what are these consolidated obligation bonds? Well, the Federal Home Loan Bank of Dallas, or the bank, gets most of its money by selling debt. These debts are called consolidated obligations, and they are like IOUs that the bank sells to investors. These IOUs promise to pay back the money with interest, hopefully. It's important to know that these bonds are backed by the financial resources of the 11 federal home loan banks. Basically, it's a group effort, but the United States government doesn't guarantee these bonds, so there is no federal backup if something goes wrong. Schedule A, which is at the end of the document, gives you a summary of all the bonds that the Federal Home Loan Bank of Dallas plans to issue, meaning they will sell it. If you look at the trade date column, which indicates when these bonds were agreed upon, you will see that there are asterisks indicating where the bank took over the responsibility of debt from another Federal Home Loan Bank. It's like musical chairs with debt, but instead of a chair, it's responsibility of debt from another Federal Home Loan Bank. It's like musical chairs with debt, but instead of a chair, it's responsibility. This report doesn't include all the short-term debt, the discount notes that the bank issues. It's only focusing on these specific bonds. This report also doesn't say anything about interest rate exchange agreements, which are deals to manage risk from interest rate changes. Also, the report doesn't tell you if the money from these bonds is being used to pay off old debts or for something else entirely. It only tells you about bonds that the bank is primarily responsible for, not any other banks that could have been involved. Let's look at Schedule I, which gives us more information. The table is where things get a little more interesting. I will tell you about the specific number that you should care about. First, on April 7, number helps uniquely identify the bond, and the bond will mature on April 9. 250 number helps uniquely identify the bond, and the bond will mature on April 9, 2027, meaning that's when the bank needs to pay back the money. The par amount tells us how much money the bank is borrowing with this bond, 250 million in debt. This bank is playing with large sums of money that most regular people can't even dream of. These bonds aren't simple. They have different features like call options and interest rates that can change over time. One bond has a variable interest rate tied to something called the overnight SOFR plus a little extra. Think of it like a mortgage with an adjustable rate. The bank made a deal or trade date to something called the overnight SOFR plus a little extra. Think of it like a mortgage with an adjustable rate. Seems ready to offer mine. This one is for 20 million in debt. This bank is playing with large sums of money that most regular people can't even dream of. These bonds aren't simple. They have the call options give the bank the right to pay off the debt early if they want to or if it's convenient. The different call styles that the bonds have define when the bank can call the bond back. For example, the European style only allows the bank to call on a specific date, where the American style allows the bank to continuously call the bond back at any time before maturity. The rate type that the bonds have explains the interest rates that the bank is paying. It can be a fixed bond where the rate is the same for the lifetime of the bond. The bank can also issue a variably bond in which the interest rates can change periodically. What does all this mean? Well, the Federal Home Loan Bank of Dallas is using debt to fund its operations. That is just the nature of the business. That is why they are taking out hundreds of millions of dollars in debt. The bonds that they are issuing can have different options associated with them, and the bank can define when to call these bonds back. The bonds can have a fixed rate, that is, the rate is the same for the lifetime of the bond, or variable, in which the rate is updated every period. Now, looking at these bonds more broadly, there isn't that much to look at. The bank is taking out a lot of debt, but that is simply the nature of the business. It is important to note that the debt is not backed by the US government, so there are no guarantees. Thanks for watching. If you enjoyed this video, please like, comment, and subscribe for more corporate deep dives. We'll keep decoding if you keep watching.